I do have a program where they prepay me money to find deals for them, because I got to, it's the same thing. If I'm going to find deals for you, that's my job. Whether you close on them or not, that's not it. You're going to pay me up front for that.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. Really excited today to have a guest who I've known for a long time. He's going to talk a lot about the non-performing and performing mortgage market. So Kevin Shortle is on the show today. Kevin, thanks for joining us.
Hey Jack, good to see you. Thanks for having me on.
Absolutely. So your company is called Real Estate Without Renters, and you actually wrote a book with that same title. Is that correct?
Yeah, that's correct. Yeah, and hit #1 bestseller on Amazon. So I was pretty excited about that just a couple of years ago. I guess it's probably 4 years ago now I wrote that. Yeah.
Oh, that's awesome. So really the mission of this podcast is to just share information about investments that are outside of the mainstream, alternative investments. So I feel like too many people are stuck in that traditional index fund, stocks and bonds in the traditional financial system, and love to highlight people that are just doing interesting and creative niche investment strategies outside of that. So tell us how you got started.
I always had a keen interest in real estate. I used to read real estate investment books and how to buy property with nothing down, all these kinds of books when I was growing up. And even in high school, somebody reminded me, they said, in high school, how everybody signs, the yearbooks and stuff, they were like, good luck in real estate. You just go back and go like, wow, I had obviously an established interest at that point. And after I graduated college, that's what I pursued, became a commercial real estate appraiser, did that for a couple of years. And then I figured the big money was in the selling real estate. So I tried that for about a year. Notice the word try there. Didn't go so well. But I'll tell you, the first thing I got, though, in that whole year is I was working on a Sunday, which the new guy had to do, people walk in the office kind of thing. And you got to remember, everybody, this was pre-cell phone and pre-internet. So people actually walk in the office and the guy came in, he goes, I want to sell my 2-bedroom, 2.5-bath townhome. And it's got an assumable non-qualifying mortgage. And he just needed a couple $1,000. So I'm like, well, go no further. I'll buy it from him. So that was my first property. And I rented, the other room and such. And so I finally got into that. But it was tough, to kind of break in and invest in real estate and real property when you're young like that. I was really kind of struggling with it. And I met a guy who had just made $15,000, and which is good amount of money today. But back then it was like, holy cow. And all he did was find a person who owned a real estate backed mortgage, write a note, and he put it together with somebody who had the money to buy it. And he made a fee in doing that exchange of $15,000. I'm like, okay, well, tell me more about this. So that's really was my initiation into the note business, and him and I hit it off, and I brought some marketing skills to the table. So I said, why don't we scale this whole thing? You've got the connections of the buyers, and we know how to find the note owners now, because database companies were just coming along. So we were able to buy lists of people who had created notes. We didn't know if they wanted to sell them or not, but it was a lead. So I said, well, I'll write a program to teach people how to do what we're telling them to do, and they can make a fee and we can make a fee, but then we can, scale it, make it nationwide. And that's what we ended up doing. So we went from a nobody in the industry to a top 10 within about 6 months, and then a top 5, about 6 months after that. And big companies are still, some of them are still around. Some of the people are, not many people were in the business that long ago, but there's a few of us that are still around in that. But that was my whole start in it. Yeah.
That's great. And let's just clarify for the audience on the type of person who's doing a seller finance loan. Maybe talk through. I know that there's probably the simplest scenario of somebody just owns a house, didn't want to pay the tax on it, or for whatever reason just decides to be the bank and they hold the paper themselves. Maybe it's for whatever reason, it wouldn't qualify for the traditional mortgage, or the buyer, for whatever reason, couldn't go to a bank to get a loan.
Right. So if we look at the individual, what I call the mom and pop notes, where it's really, that's the only note they're ever going to create, sort of thing. And then of course you have investors that buy real estate, sell it with financing, create notes that way. But the mom and pop notes is really where we started. And that was, to your point, a lot back then was interest rates. Everybody thinks interest rates are high today, right? They were 18%, back during the Carter administration. And so imagine that, signing a 30-year loan for 18%. Well, a lot of people weren't going to do it. So what they started doing, we got to sell our house. You don't need to pay the bank, pay me. And they would create seller finance loans for like 8-9%. Not really because they wanted to, but they really needed to sell their property. So those are the folks we were tracking down back in the day. And again, before we had lead lists, I had to go to the courthouse and look at microfiche and all that kind of stuff, find these leads, so you truly had to mine it. But once I figured, hey, I can teach people how to do this and expand it, it really was a game changer. And to the profile of somebody on the mom and pop side, it's interesting. The numbers just came out. There's a company out of Oregon that puts out numbers every year about how many seller finance notes are created. And in their report, they list the top states. And the top states really haven't changed much in 30 years, with a couple of exceptions. So Florida is still up there. They're number 2 behind Texas. So Florida, Texas, California, and North Carolina are the top 4 states that seller finance notes are created. And when you look at those states, and Arizona is not far behind, but it's dropped out. So that was the one that's kind of changed. But if you look at those states, the common denominator is what? Retirees. So I think the notes that were created on the mom and pop side, after the reason I just explained from the high interest rates, more today, it's somebody who, when they sell their house, they don't need or want all the money or pay all the capital gains taxes on it, and they'd rather just get the payments on a monthly cash flow. And, life changes, right? So when you reach out to those folks, for those who pursue that angle of the business, it's not the only angle, everybody. There's a lot of different ways to approach this business. But for those who are looking to just put buyer and seller together, life changes. And sometimes people just go, hey, now I do want to sell. We had health problems, or we have an investment opportunity, or whatever it is. So that still is a viable business today. The guys over at FNAC, First National, they've been doing that model for 40 years, 50 years. They just had their 50th year. So it's a model that's been
that's pretty incredible. And I'm surprised that they're an actual bank as well. And I'm surprised there's not more banks that are a little more entrepreneurial, but it's probably good for you and I that there aren't, because otherwise they might just
take over the
eat
industry.
Up too much of the market. Yeah. So you covered the mom and pop side of it. And then let's talk a little bit about the other side of it, those that are more full-time investors, flipping houses and using seller finance as part of an overall investment strategy to create notes that they probably create knowing they're going to sell.
Yeah. So as an investor, you look at, what's my inventory level, right? That's kind of where you start from. And in our business, there's really 3 funnels. There's the mom and pop notes, which is a smaller percentage, but an active one. You've got the bank notes on the other side, which we only see on the non-performing. Banks don't sell performing notes. They sell non-performing notes. And then we have in the middle, we've got the investor loans, which are small investors and or investment funds, that they'll pool money together. They'll buy 30 houses, fix them up, turn around and sell them with financing, make it easier for buyers and those sorts of things. And eventually in those funds, they have to cash out the investors, right? You got to close a fund, maybe start another one, whatever the case may be. So a lot of these companies will go from buying real property to creating the paper. And next thing you know, they've got paper, they've got monthly cash flow without being the landlord. And eventually they need to sell off that paper, to pay the investors back and everything else. So we try our best and do a good job of building relationships with those companies, because it's a symbiotic relationship, right? They need us, we need them, sort of thing. They're out there creating this paper, seasoning it up a little bit, and we come in and cash them out. Yeah. So that's that's probably been the busiest funnel of inventory that I've seen in the last 5 years, because the bank loans, that funnel was full blast when we had the big crash. But since then, delinquencies on mortgages are down substantially. new bank rules and regulations, especially in a political environment, nobody wants to see people get into foreclosure, right? Politically charged year. So they're pressing the banks, Fannie Mae, Freddie Mac, Ginnie Mae, which are the secondary note buyers for the banking industry. They are really pushing banks to try to do workout resolutions rather than foreclosures. So we haven't seen nearly as many non-performing loans. And my guess is we're probably, as far as overall inventory, probably 85% or so performing notes right now versus non-performing notes. That's about what I see.
Great. And I spent obviously a lot of time on the bank side with performing and non-performing, and,
Right.
and you're completely dead on. The government's really pushing for modifications at all costs. Now, fortunately, we always made more money modifying loans. So our goal was always to modify and to keep a borrower in their house if we could.
Right.
But unfortunately, there's just some scenarios where they probably should have never gotten the house, especially when you look at back pre-2008.
Yeah, there were
people. There were liar loans where if you could fog a mirror, you could get a mortgage.
Right.
And most of those loans have kind of run their course, but it's not out of the question to see one where they've done 3 or 4 modifications that failed and just the person just can't afford it. Unfortunately, sometimes the government just puts you through a lot of red tape when there's really no other viable option.
Right.
But overall, it's been a pretty crazy run over the last 10 years. How have the returns and the pricing changed in the last 2 or 3 years, going from a record low interest rate environment to, rates going up in the last couple of years? How has that impacted your business?
It really hasn't impacted it much at all. Non-performing notes, I think, are still a little pricey right now, but I think that's more inventory driven than it is having to do with the interest rates. And performing notes, they're trading typically on the retail level, like the investors buying them, personal notes. We're getting them at between 10 and 12% yields. That's about where it would bell curve out. Which I think is great. That's a dang solid yield. But the other plus side of that is there's less risk in performing notes today because of the equity. So a lot of these loans that I see, doing this a long time, it's pretty cool because I save all my computer stuff and I'll see a property or address and I'll go, God, that sounds familiar. I'll look it up and go, oh man, I taught somebody to buy that thing like 10 years ago, non-performing. Now it's performing. Now they're cashing out of the note and that sort of thing. So, but your risk is so much lower because, we're finding $30,000, $40,000 notes on $100,000, $120,000 houses, so even if property values drop 20%, you're still totally fine. Yeah.
Yeah, that's great. Now, when you say 10 to 12 yield, are you talking current cash on cash? Or are you talking about the net present value factoring in that you buy it at a discount and if it pays off early, you could have an additional
annualized return. So it's the financial calculator, present value, and you run that through and 10 to 12%. The payoff, that's extra bonus yield. That's where the discount comes in, right? So that's where you get some extra yield in there, But 10 to 12 when you run it through, and that's pre-servicing fees, for those who are getting servicing loans. But that's about where they're trading. Yeah.
Yeah. So simple math for somebody that just is really new to the business. That $40,000 note, for example, if it has only a 6% interest rate, you might pay $32,000 for it, so that the amount of payments coming in gets you to the point where you're making 10% annually on your purchase price. And then if it does pay off early, you're getting paid back 40. If it paid off the next day, but you only paid 32.
Exactly. Yeah.
If you hold it for 15 years to term, eventually it goes down to zero eventually, but then you've averaged 12% or 10%.
Right.
So your worst case scenario is it pays off in full. Every day it pays off early, you're actually getting a higher return.
Yeah. And I watched that. I haven't seen the latest report on that, but I remember maybe 10 years ago, the average tenancy where people were staying in their house was about 7.5 to 8 years, because property values were going nuts. And then now with interest rates are going up, of course, you have people who are locked in. They're like, hey, I got a 2.5% mortgage. I'm not going anywhere. I can't sell my house and, buy next door because the interest rates are, 7.5% for a loan. You're right. When we buy these things, it's always at a discount. We can't buy a note from somebody and say, hey, we just bought your note. We're going to kick your interest rate up from 6 to 12%. So the way we make that 12%, the consumer still pays on the 6%. It's just we paid a discount for that cash flow, as you were pointing out, and that puts us up there. But if people are paying off, in about 13 years, some of the notes that we buy, you look at them and you go, I was looking at one this morning with a client of mine, and the lady's been in the house since 2005, So she had the loan modified. She ran into trouble 2010 and got the loan modified. It stretched it out a little bit more. And she actually declared bankruptcy. And Chapter 13, which, a lot of investors think that's a negative thing in the note space. It's great. And so now my investor who's buying this is going to get two returns. He's going to get the return of the mortgage payments going forward, and he's going to get the arrearage account that's being paid back as well. So he'll be in that thing for about 16.5% yield for the next 4 years, and then it'll go back down to about 10.5%.
Yeah, I love Chapter 13 bankruptcies as well. We did a lot of those when I was in New York on Wall Street. It's I think one of the most untapped areas to focus on. I don't know that we've ever talked about partials. I've done a couple episodes on notes, but can you, I don't know if you do much with it, but I'm sure you could explain it. Can you kind of talk through the concept of partials and how investors can take advantage of that?
Yeah, I love doing partials. In fact, I've got several people working on some right now. And the whole idea is, if you think of these loans as monthly income streams, linear, like it goes out 20 years, 240 months, and you start to think of, well, if the monthly payment is $1,000 a month, that last payment, that you're waiting 240 months for, that $1,000 is not worth $1,000 for you today. In other words, if I propose to somebody, hey, I'll, give me $1,000, I'll pay you back $1,000 in 30 years from now, you'd be like, what's $1,000 going to be? The point I'm trying to make here is there's a difference between future value and present value. So this is what the play comes in with a partial. You buy, and we always use this example. Let's say you buy a pizza, and you pay $12 for the pizza. You could probably turn around and sell 2 slices of that pizza to somebody, $6 each, and now you got 5 slices left on the pizza there. So when you think of that in terms of notes, we might have 240 payments. I could sell you half of the payments, a quarter of the payments, any number of payments today for lump sum. And then I get all the rest. And if you do this properly, and you need a little financial calculator to run the numbers, but there's a lot of scenarios where you can buy the whole note and sell about half of it to another investor and get all your money back. So what you could do then is take that money, buy another note, but you also have the back half of that note, which eventually will come to you in the form of payments, or as we were just pointing out, that people might sell the house in sometime within around 13 years, and then you get cashed out at that point. So partials is buying the whole note, selling off a portion of it to recapture either some of your capital, all of your capital, in some cases more capital.
Great. And this is generally handled completely with a third-party loan servicer. Is that right? There's companies that can do all the math and collect all the payments and send all the distributions. And
so servicing company, the servicing company's collecting the monthly payments. And let's say I sell 65 years worth of payments, 60 payments over to you. We'll have a contract on that outlines all of that, where it shows all the entitlements. You're getting the next 60 payments in exchange for $20,000, whatever it is. And then after the 60th payment, the payments come back to me. So the servicing company who's collecting the payments gets those instructions. So they basically, payments coming to me, and they go, all right, we're going to stop that. We're going to flip it over here. And now they're sending the payments to you for those 60 months. After your 60 months, comes back over, and then I get all of those payments back. And that's kind of a cool thing when you think about it. In real estate investing, real property, you buy a house, you can sell it once, right? When you buy a note, you can sell it multiple times because you can sell any portion of it. So I do have student clients of mine that, purposely buy notes that have longer terms, 200 plus months, because the numbers really start to look better the lengthier the term is. And they do it because they're using that technique. They're going to buy the whole note, long-term note, carve up part of it, sell it to somebody else, and then buy another note, and then wait for the payoffs.
Yeah, it's a really, really powerful technique. Yeah, I've actually never done it, but I've been fascinated for years. When we were in New York, we were a little too corporate. There was just things we weren't allowed to do. But yeah, I'm fascinated by it. And obviously you need to do the math, because when you sell the earlier payments, it is a higher portion of interest and less principal. The later payments obviously have more principal, less interest. But again, you have that asymmetrical upside. If the loan pays off early, you had all your money back early ahead of time, and then you're going to get all the remaining payoff as well. And if not, you've got majority of your money back up front, which you could buy another note with. Yeah. And you mentioned retirement accounts. That's actually a great topic I was about to pivot to anyway, because I actually this last weekend, this is probably going to take a couple weeks to come out, but I attended a 2-day tax and IRA seminar with John Heyer, who's one of the prominent IRA tax attorneys. So he told me some strategies that that just blew my mind on maximizing your retirement accounts. And what types of strategies are you and your students using with buying in the retirement accounts?
Well, one that I've been teaching for a long time is what people don't understand about self-directed IRAs and 401ks and such is the IRS says that you have to invest at least $100 to have a legitimate investment. Okay. So very low threshold. And when you learn how these numbers work, and when I'm teaching this in a class, of course, we have the benefit of a spreadsheet and I can show you how all this works, but you could invest as little as $100. So let's say you find a note and the note balance is $100,000 and you can buy it for $70,000. Okay. So you're going into an agreement with that. And then it's like, all right, so I need $70,000 to close this thing. We'll just call it the closing table. So you need $70,000 at the closing table. Well, you bring an investor in for $69,900. And then you're going to kick in $100 from your IRA or your kid's IRA. I have one of my clients has four kids. All of them have IRAs, and all of them are investing a little bit of money in all these. He's got like 20 notes now. They all have a little bit of money in each of these notes, and he's setting them up for life. So getting back to this, you got $69,900 from another investor, and then you've got $100 from your IRA. And when you run the numbers, if it's a 30-year loan, we might give the investor at $69,900, he might get 150 payments, somewhere right around there. So about half, a little less than half. So about 150 payments, and that'll get him around a 9% return, depending upon where the note's written. So he's happy. He's in the note for that period of time. The $100 IRA owns payment 151 to 360 for $100. Now, again, if you're thinking long-term retirement, most people today, again, don't stay in a house for 30 years. I mean, our parents and grandparents did. That's all completely changed. People move and stuff today. So you're essentially tying up with $100, a whole back end of a loan, which if thing pays off, you're probably making 80, 90 grand, in that example, if it pays off early or you get the payments in the future. So that technique is really, really powerful. The point being that you don't have to invest everything. You can partner your IRA with another investor, something like that. But if you're just buying the note yourself with an IRA or 401k, getting all of this money tax free. I mean, it's a game changer.
Yeah, one of the most game changing things that I learned at the recent seminar was about converting from the IRA or a solo 401k that's pre-tax and converting to a Roth. And
right.
That scenario you just outlined where you're on the back end and whether it's $100 or even let's say there's a scenario where you have 25,000 in
sure.
and you do the same scenario, but since you're getting payment 179 to 360, there's actually a discount that can be applied to it because you need to wait for a certain amount of time. And then there's a liquidity discount. So what one of his recommendations is you actually make the investment in your pre-tax IRA account, or solo 401k account, get an appraisal. And then once you have that appraisal, you can convert that to the Roth at a discounted rate, whether it's a Roth or a Roth 401k.
Right.
And so that 25,000, when you do an NPV or get an appraisal, you might be able to get that value down to 10,000 instead of 25. And now you're converting to your Roth and paying tax only on the 10. And that same 70, 80, 100,000 that you might get in 10 or 20 years is completely tax free forever, as opposed to with the traditional solo IRA or, the pre-tax IRA, you do have to pay taxes on it. So that just blew my mind. And that's like even another step, it's on steroids. Everything you said, it's on steroids now. Again, if you can convert it to a Roth as well.
Yeah, 100%. That's where some people go in going, well, I don't have enough money in my IRA or 401k. You know, I'm like, you have $100? You know, you can do it. You know, in this business, it's, and you know this for, you know, with all your experience, it's the ability to identify a deal is the most important skill. You know, that's the muscle that you have to exercise, because if you have the ability to identify a deal and present that to somebody, the money's out there. You know what I mean? It's just a matter of understanding. And that's why I'm so heavy on the education. And that's why I'm a consultant and teacher and trainer and such. And really one-on-one mentor is what I do every day with my students. And just, you know, it completely changes your whole outlook when you know it so well, you know what a good deal is. And if you can't fund it yourself, you sure can either make a fee, having somebody else fund it, or partner with people, or just structure the deal. So that's truly what I believe.
Yeah, that's great. So obviously you're an author, you're a speaker, you're a coach and trainer,
yeah.
And it sounds like you have somewhat, whether it's formal, informal, somewhat of a mastermind group of your other students. Talk a little bit about how you work. If somebody's interested in getting into the business, just kind of take us from step 0 to step 1 on how you work with someone.
Yeah, it's interesting. You mentioned the term mastermind, because the initial definition of mastermind has really been skewed. You know, people have mastermind groups and things like that. And I know there's some benefit to some of the groups maybe not so much. But truly the definition of a mastermind, which was through, I have it right here somewhere. But anyway, it's through, oh gosh, I'm trying to think of the guy's name. It just popped out of my head. But it's 2 or more parties with a common focus on one objective. And that's what's, I think, happened with some of these mastermind groups, where you get 10 minutes to speak, you get 10 minutes. That's not really truly what's meant by a mastermind. It's one person, two or more people focusing. So the way I work with people is through Zoom, right? So the technology enables where we can share screens, look at public records, we can look at all the inventory, we could run the numbers together, we can look at all the documentation, payment histories, and all these deeds and mortgages and notes and everything we look at on a one-on-one basis. So that has really been a game changer. There's nobody else in the industry doing what I'm doing, because it does take, a lot of time and effort. Everybody likes to just everybody get on Zoom and I can do one session and be done with it. With me, it's one-on-one, unlimited, 5 days a week, as much as you need help. And I just go through every single step with people. And obviously, when you do it that way, people are going to get results. I mean, because I'm there, it's every step through the whole process. So it's been great, and it's been a lot of fun. I've been doing this a long time, and I was kind of concerned. I said, how many clients could I take on, and doing it this way? And that was definitely a concern when I started this about 5, maybe 6 years ago. And what I found was the education curve when you're working with an expert, me one-on-one, your learning curve is shortened so much. So I've got clients that within a very short period of time, they don't need me for all the basics anymore. They don't need me to go to the inventory sources. I already gave them that. They don't need me to run the initial numbers, ITVs, investment to balance, yields. They don't need me for that anymore. They know what documents to ask for. And some of them get within 3 months, they're already making offers on other things subject to, further due diligence. And then they'll schedule an appointment with me and say, got an offer accepted on this one. Let's go through it. Let's just make sure I haven't missed anything. Let's make sure, that I haven't made any mistakes on it, and just recheck everything. So I've got clients who've been with me 5, 6 years that I might hear from 2, 3 times a year. Because they just don't need me until something different happens. A bankruptcy's filed, or a note goes bad, or they're buying a note, with something that they haven't encountered before. So it's worked out great. So that's why I can go to unlimited, just have people. I had one guy, he really tested the theory. He booked an appointment every single day his first week, and I'm like, that's fine, no problem, and he got into 2 notes pretty darn quick. So, yeah.
Great. So you're definitely helping people find their own deals. And are there people who really just want to invest, who just want to kind of put their retirement account money to work as well? Or are most people, actively pursuing finding their own deals directly from sellers? Actively pursuing,
at least with my clients, they're actively pursuing that. Because what I've found in the past, as being a speaker, and I've done trainings, nationwide. I've been doing it, speaking for about 25 years. And inevitably, people will come up to me after a class and just say, hey, look, I don't want to pay for education, but I've got $1 million and, would you just find deals for me and I'll pay you a fee, just, when we close on a deal or something. And in my early days, I was like, well, heck yeah, I can do that. And what I learned very early on, those people never do anything, because I'll bring them a deal and I put all the time and effort, no money, all the time and effort. Here you go. Here's 2 options. These are both good. Yeah. Well, what about this? What about that? I didn't know about this. And I'm like, so you're saying is you're not educated. You need the education to move forward. So it just, a confused mind's not a buying mind. You know what I mean? And that's where investors who come to me and just say, hey, I just, just going to invest, I'll pay you when we close on something. I'm like, no, not interested. Not interested. I do have a program where they prepay me money to find deals for them, because I got to, it's the same thing. If I'm going to find deals for you, that's my job. Whether you close on them or not, that's not it. But you're going to pay me up front for that. Yeah.
Gotcha. I know we touched on it briefly, but regulation. We mentioned the states that are, I think the states you listed are also, I think, pretty seller finance friendly.
Yes.
Has there been any major changes in recent years, or states you avoid, or just pitfalls investors need to be careful of if they're thinking about buying them?
Right now, New York. Gosh, I mean, I'll look at stuff in New York if the numbers are really, really right and it's a really strong performing note. But it takes 4 years to foreclose in New York now. And not that I've never had to foreclose on anybody, but a lot of times you have to threaten foreclosure. You have to file foreclosure to wake them up, to start the conversation, to get them to find out, hey, we can help you without foreclosure. But, a lot of people, when they know it takes 4 years to foreclose and they're not paying on their loan, they go ahead, start foreclosure. I don't care. It's going to take you 4 years anyway, and that's a tough pill for a lot of people. So New York, until they straighten out some of those laws, I'm avoiding that unless it's a really low balance, high equity performing note with a lengthy history. Other than that, nothing else really stands out. There's the land contracts, which your listeners may or may not be familiar with. But when you have a contract for deed, also known as a land contract, some states have laws on that, like Michigan, and it's much easier process. Other states, you're allowed to create them, but they don't really have laws as to how to handle it. The idea behind a contract for deed, for those who don't know, is that the lender actually goes on the title to the property, and they stay on the title till they're paid in full. Well, what happens if the person stops paying? Well, possession's 9/10 of the law, and the agreement is I can evict that person versus foreclosing. However, if they lawyer up like in Ohio, most oftentimes a judge is going to side with the delinquent borrower and say, we're going to make you foreclose anyway. I know the agreement says you can evict, but we're going to overrule that and say you got to go through foreclosure. So there's certain states like that.
Gotcha. Yeah, I know Georgia comes to mind.
Just prepare for foreclosure.
Yeah, and I think Georgia, you're only allowed to have one mortgage. Otherwise, you're supposed to register as a debt collector. So there's certain random things where you may need a license here and there for certain things, but it's nothing too onerous. I mean, I know a lot of people through in our circles that have had great success, including myself, with buying performing paper, whether it's seller financed or bank paper. I think it's a great tool available for investors. I mean, most people just think of real estate as rental properties, but being a lien lord instead of a landlord is can be a great benefit.
I'll tell you what, you like the stories with the alternative investments. We used to buy lottery winnings, casino winnings, royalties for musicians, for actors, actresses, professional football players, cellular phone tower leases. I mean, just all kinds of crazy stuff, structured legal settlements, all kinds of that stuff in the day, which was pretty interesting. But it comes down to this whole premise. When you're buying debt, which is really what we're doing, the debt we focus on, you and I, is really backed by real estate. That's our collateral. So we have to know how to value that collateral and everything else. And then we do our best to insure things that we can't cover a risk on, the house burning down and stuff like that. With buying the alternatives, like the royalties and stuff, it all came down to the same thing. What's the collateral worth and how do we insure it? So I use the example of all the time. One of these deals, we were working with a football player, and he wanted to sell next year's salary today. So we can do the math on that, because in the NFL they get paid 1/16 of their annual earnings during the season, right? But what's our risk? Well, our risk, you have to look at the contract, just like when we look at real estate contracts. What's in the contracts? What are the rights and obligations in there? In the NFL contract, there were two things that were tough for us to overcome, which was your on and off field behavior has to be up to team standards, and your fitness has to be up to team standards. But they don't really tell you what the team standards are, So it's one of those typical, if we want you off the team, we're gonna do something. So, we're looking at this policy, at this contract, and just said, well, here's our risk. So how do we cover our risk? Well, let's have this guy get an insurance policy, saying that if he gets hurt, if he loses his fitness, if he gets in a fight, on or off the field, we're covered. So very similar type of approach to real property. What's the collateral worth? What's the worst case scenario? Am I still making money on it? What can I insure to cover my risk? And what are these still unknown risk? That's what we had. So we did a lot of those type of deals, which was pretty fun. I don't see those too much anymore.
Yeah. Did you ever do anything with buying life insurance policies? I met a guy on an investor cruise recently, and said some people, they pay into these policies for 20 years, and then sometimes they just either run out of money or they don't need it anymore. I mean, one scenario he gave is someone was going to walk away from a multi-million-dollar policy because he had it because if he died first, he wanted to make sure his wife was taken care of, but his wife died first, and he was about to walk away from a multi-million-dollar policy just for paying, $50,000 a year on it. And so this investment group buys up these policies. They have a network of brokers usually, because the broker still gets commission every payment. So the broker doesn't want the policy to go away. And it's pretty capital intensive, but it's pretty lucrative on the back end. But it's pretty morbid, because you kind of look at that person and be like, hey, how old are they? Do they have 5 years left? Do they have 10 years left? You're kind of rooting against them, I guess, for the highest return. But but you're also doing them a service and giving them some money up front for something that they might have walked away from or couldn't afford to keep.
Yeah, I know the whole history on that, and we avoided those because the creepy factor was too much. The sooner they die, the higher your return, and that kind of stuff. So it was kind of weird. So that one we didn't get involved on that one. That was too much.
Great.
Some of the other stuff was fun. I mean, like the lotteries. A lot of people don't realize. Lotteries today have a cash lump sum. They didn't used to have that. It was always paid over 20 years or 30 years. And the same thing with the casinos. It was, if you win Quartermania for $10 million, you see people with the big paper check, for the 10 million, read the side of the machine. It's paid over 30 years, And so we used to buy those. And then the states all with the lotteries came in and said, well, if anybody sells their lottery, we have a right to not pay anymore. And the casinos did the same thing. And then remarkably, both the states and the casinos came up with their own plan, and I went back and checked the yields on what we used to make, because part of the ruling with the lottery, or their understanding, I shouldn't say ruling, was that we were making too much money, too much of a return on buying those. And the reality was, when you run the numbers on what the state offers versus what we offered, we would offer a lot more than the states, so it's pretty interesting. The government can get away with it. We were given a pretty fair deal, to people, but it's just interesting to see those things change. It's
government's not one of my favorite entities. It obviously serves its purpose, but I think unfortunately there's that's a whole other topic of getting into unintended consequences of overregulation or just being anti-competitive.
No, I was just going to say, a lot of people recently, a lot of bands jumped on the selling the royalties, right? Bruce Springsteen sold his stuff. David Bowie was the first one. You have all these bands where, they get these royalties for all their music and they sell that, Bob Dylan sold his. I mean, a lot of people still doing that. Yeah. Sorry, go ahead.
Yeah, no, it's a great, look, people need liquidity. Whether it's notes, royalties, structured settlements. It's part of what makes capitalism great. Is there's a niche in the market for time value of money, and in the note niche, you fill a great spot there. So you've dropped a ton of great information for the audience here. Tell everyone how they can get a hold of you.
Yeah, sure. You can shoot me an email if you'd like, and I've got a link I could send you if you want to have a conversation and just talk about the business and maybe what I can do to help you. Just email me at Kevin Shortle, and it's spelled Shortle. So it's Kevin at Kevin Shortle, Shortle.com. And I'd be glad to send you a link. We can have a conversation. You can get my website. You can go to realestatewithoutRenters.com or kevinshortle.com. It'll take you to my website, YouTube channel, all that sort of stuff. You could Google search me and find me pretty quick.
Great. And we'll put all that in the show notes as well. So, awesome. Kevin, thank you so much for coming on the show.
I appreciate it.
All right, everyone. And don't forget to like and subscribe on YouTube, Spotify, iTunes, and connect with JKM Investments and Alternative Investor Mastermind on all major social media platforms. Thanks, and we'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.